Introduction. Indicators and oscillators are technical analysis tools used by traders to analyze and make predictions about the price movement of financial assets, such as stocks, bonds, commodities, and currencies. Definition of indicators and oscillators. An indicator is a mathematical calculation based on the price or volume of an asset, used to forecast future price trends. Indicators provide insight into market trends, momentum, and potential trend reversals. An oscillator, on the other hand, is a type of indicator that oscillates between two extreme values, indicating whether the asset is overbought or oversold. Purpose of using indicators and oscillators. The main purpose of using indicators and oscillators is to provide additional information that can help traders make informed decisions about buying or selling a financial asset. Indicators and oscillators provide a visual representation of market trends and momentum, and can help traders identify potential entry and exit points. They are also useful in identifying trend reversals and overbought, oversold conditions. Common types of indicators and oscillators. Some of the most commonly used indicators include moving averages, Bollinger Bands, and the Moving Average Convergence Divergence, MACD. Momentum indicators include the Relative Strength Index, RSI, Stochastic Oscillator, and Williams Percenter. Volatility indicators include Average True Range, ATR, Bollinger Bandwidth, and Historical Volatility. Oscillators include the Rate of Change, ROC, the Commodity Channel Index, CCI, and Stoch RSI. 2. Trend indicators. Trend indicators are used to determine the direction and strength of a trend in the market. They help traders identify whether a trend is bullish, upward, bearish, downward, or neutral. Here are 3 common trend indicators. Moving averages. A moving average is the average of an asset's price over a specified number of periods, usually a number of days or weeks. Moving averages can be simple or exponential. Simple moving averages are calculated by adding up the closing prices over a specified number of periods and dividing the total by the number of periods. Exponential moving averages give more weight to recent prices. Bollinger Bands. Bollinger Bands are a volatility indicator that consists of a simple moving average and 2 standard deviation lines plotted 2 standard deviations away from the moving average. The distance between the bands expands and contracts based on volatility. When prices reach the upper band, it may indicate the asset is overbought, and when prices reach the lower band, it may indicate the asset is oversold. Moving Average Convergence Divergence, MACD. The MACD is a momentum indicator that calculates the difference between a fast-moving average and a slow-moving average. The MACD line is the difference between the fast and slow-moving averages. A signal line, usually a 9-day moving average of the MACD line, is plotted on top of the MACD line to generate buy and sell signals. A cross above the signal line indicates a potential buy signal, and a cross below the signal line indicates a potential sell signal. 3. Momentum indicators. Momentum indicators are used to measure the speed and strength of price movement. They help traders identify whether an asset's price is increasing or decreasing, and at what pace. Here are 3 common momentum indicators. Relative Strength Index, RSI. The RSI is a popular momentum indicator that oscillates between 0 and 100. It compares the magnitude of an asset's recent gains to the magnitude of its recent losses, and generates a value between 0 and 100. A value above 70 indicates the asset is overbought, while a value below 30 indicates the asset is oversold. Stochastic Oscillator. The stochastic oscillator is a momentum indicator that compares an asset's closing price to its price range over a specified number of periods. It generates a value between 0 and 100, with readings above 80 indicating overbought conditions and readings below 20 indicating oversold conditions. Williams Percenter. Williams Percenter is a momentum indicator that compares an asset's current close to its high-low range over a specified number of periods. It is plotted on a scale from 0 to -100, with readings above -20 indicating overbought conditions and readings below -80 indicating oversold conditions. IV. Volatility indicators. Volatility indicators are used to measure the market's price movement and the degree of price variability over a specified period of time. They help traders assess market risk and determine the level of price fluctuation. Here are 3 common volatility indicators. Average True Range, ATR. The ATR is a measure of an asset's volatility, calculated as the average of the true range over a specified number of periods. The true range is the greatest of the asset's current high minus its current low, its current high minus its previous close, or its current low minus its previous close. Bollinger Bandwidth. Bollinger Bandwidth is a volatility indicator that measures the distance between the upper and lower Bollinger Bands. It provides a visual representation of an asset's volatility, with expanding bands indicating increased volatility and contracting bands indicating decreased volatility. Historical volatility. Historical volatility is a statistical measure of an asset's price movement over a specified period of time. It is calculated as the standard deviation of the logarithmic returns of an asset's price over a specified number of periods. Historical volatility is used to assess market risk and to compare the volatility of different assets.